EBITDA margin, or earnings before interest, taxes, depreciation, and amortization margin, is a financial metric that measures a company's operating profitability as a percentage of its revenue, before accounting for non-operating expenses, such as interest, taxes, depreciation, and amortization. It provides insights into a company's ability to generate earnings from its core business operations, excluding the impact of financing decisions, tax rates, and non-cash expenses related to asset depreciation and amortization. Here's a breakdown of EBITDA margin, including its formula, interpretation, and significance. 1. Formula. The formula to calculate EBITDA margin is as follows. EBITDA margin equals frac EBIT revenue times 100%, where EBITDA, earnings before interest, taxes, depreciation, and amortization. Revenue equals total revenue or sales. 2. Interpretation. EBITDA margin is expressed as a percentage and represents the proportion of a company's revenue that translates into operating earnings before considering non-operating expenses. A higher EBITDA margin indicates a greater percentage of revenue is being converted into operating earnings, suggesting higher operating efficiency and profitability. Conversely, a lower EBITDA margin may indicate lower operating efficiency or higher expenses relative to revenue. 3. Significance. Operating efficiency. EBITDA margin provides insights into a company's operating efficiency by measuring the percentage of revenue that contributes to operating earnings before considering non-operating expenses. Comparative analysis. EBITDA margin is commonly used for comparative analysis within an industry or across companies of similar size and business models. It allows investors and analysts to assess how efficiently a company generates operating earnings relative to its peers. Financial health. A consistent or improving EBITDA margin over time may indicate strong operational performance and financial health, as it suggests that the company is effectively managing its costs and generating profits from its core business activities. 4. Considerations. Capital intensity. EBITDA margin may vary across industries due to differences in capital intensity and operating models. Industries with high capital expenditures or asset-heavy operations may have lower EBITDA margins compared to industries with lower capital requirements. Debt structure. EBITDA margin does not account for interest expenses, which may vary based on a company's debt structure and financing decisions. Therefore, it's essential to consider a company's overall financial structure and debt obligations when interpreting its EBITDA margin. Non-operating factors. While EBITDA margin focuses on operating profitability, it does not account for non-operating factors such as changes in working capital, one-time charges, or extraordinary expenses. Analysts may complement EBITDA margin analysis with other financial metrics to gain a comprehensive understanding of a company's financial performance. In summary, EBITDA margin is a key financial metric that measures a company's operating profitability as a percentage of revenue before considering non-operating expenses. It provides insights into a company's operating efficiency, comparative performance, and financial health, making it a valuable tool for investors, analysts, and stakeholders.